but you've got another one I think that a lot of folks may not know. First, give me your macro take. I mean, are we starting to see the light at the end of the tunnel with equity markets stabilizing and the Fed still juicing us?
Well, I have a hard time saying that equity markets are stabilizing. We're still seeing outsized moves, whether they be on the downside or the upside. So it's very hard to want to make significant changes in portfolios when you see this kind of volatility, right? The VIX only measures the downside volatility, but we've certainly seen it on the upside as well. But we are constructive that when we come out of this, we are going to be facing an economy with a lot of stimulus behind it. You have a lot of people talking about that we're not going to fill the hole with seemingly $2 trillion a day. We take the flip side of that coin and think that interest rates are really low, pent-up demand will come back, and the economy was strong going into this and will eventually be strong coming out of it. So we're constructive on markets and don't think we're going to hit those bottoms that we saw a few weeks ago.
Does that mean that you want to own the same things that worked before this? Business as usual, life mostly as we know it?
Well, I think in the things that were working before were companies that were seeing revenue growth before this all happened and companies that were moving fast into the gig economy. So you do still probably have a lot of those winners continue to win. If you look at it, growth has continued to outperform value even in a significantly down market, which is odd. But you have some really beaten up stocks out there that will probably be the first leg to come back. You look at companies like the cruise lines and the airlines that were down 60 and 70%, probably have the most move short term, but longer term you want to own those companies that are going to continue to grow coming out of this.
Yeah. All right. So one of those, we're going to talk some Disney because everybody's been watching Disney. It's been slammed during this because the parks are closed. But I want to hit another stock real quick that you've got your eyes on that I don't think a lot of people know, called Dover, ticker DOV. This is about as industrial and cyclical as they get, right?
Right. And you were value-oriented managers, so we really loved to own companies like Dover. Dover makes things that work, and they make them at a reasonable valuation. And as a value investor, you're either looking to buy good companies at great prices or great companies at good prices. And I think in Dover, we found a great company that at a point was trading at a great price, and that is a rarity. So we built a position in that thinking as the economy recovers, the pent-up demand for their products is still there. They make things like flow controls and car alignment equipment, some really mundane things that you're probably not going to see on TV commercials and you may not even recognize.
Yeah. All right. Now, does that mean that you expect some kind of infrastructure plan as another part to this? Do you need any of that? That's been rumored once again. I feel like there's always rumors of infrastructure week and infrastructure plans, but that's also been in the mill lately, stirring the pot on, I think, some of these industrial stocks.
Yeah, I think you have a period of time where you have unprecedented cooperation between both parties, and an infrastructure plan seems to be a great way to soak up the unemployment at the very low end of the economy as infrastructure deals start to get put into place. Even though we are going through a government-sponsored shutdown of the economy, businesses are still going to right-size themselves coming out of this. So the unemployment rate will still be higher than it was going into this, and nothing like a good infrastructure plan to help suck up some of that hourly labor force.
All right, let's talk Disney. What needs to happen? Do you need to see this containment policy lift fast? I mean, parks are still the biggest revenue driver for this company, despite all the streaming efforts that they've made. Is this relying on a read on human behavior and assuming people will go back to crowded parks the way they did?
Yeah, I think it is a read on consumer behavior, and I think that we're having a hard time keeping people in their houses as it is, right? You see more and more stories about people congregating when they're not supposed to. So the very premise that people are not going to congregate when they even see a glimmer of hope in this, I think is somewhat misguided. So we do expect that people will go back to parks. We do also see that parks are something where Disney has very tight controls on who goes in and out of their parks. It is not a concert where it's hard to, decide who's coming in and coming out. And there's already talk that they're going to be taking people's temperatures as they go in. We're pretty confident that if somebody can handle large crowds, it is Disney. And then you have to look at the rest of the product lineup for Disney, and that is over-the-top streaming of media and then eventually sports. So we always have wanted to own Disney, but when it's trading at $140 a share, we thought it was a little rich. We saw our opportunity as the parks closed, really. And sometimes you have to be greedy when others are fearful. And I think that's what we did with Disney.
Disney, how long of a time frame do you expect to hold this stock for?
You know, our typical holding period is we look at what we think the value of a company is 18 to 24 months into the future. An effort like this makes you want to look at what are the companies you want to own for the next 5 years? What's a portfolio look like 5 years from now? And buy the cheapest things when you can get your hands on them. Who knows what's going to happen through the summer? Who knows if we get a shadow boom in COVID-19 in the fall? It's just unknowable. So you have to try to invest in the things that you think have long-term legs, and Disney's definitely one of them.
Do you worry with the success of Netflix during the shut-in period that they've reestablished their moat for content? I don't hear a lot of people talking about Disney Plus right now. All I hear about is Tiger King.
Well, Tiger King was certainly a unique offering from Netflix. I still think Netflix is going to begin to suffer as other content is pulled from Netflix, where they really have to have hits like Tiger King, where Disney has a catalog and a power in merchandising and parks that is very hard to beat, and a sports franchise. So I think either Netflix is going to have to get into some other areas, whether it be live sports or whether it be other areas of media, where Disney already has a very broad range of products that it offers. And all this has done is encourage people to learn how to stream. So coming out of this, those with compelling streaming offerings are all going to survive.
All right, Tim, let's go. Appreciate the insight here. We're going to do some trading here on some of these stocks. Tim, joining us from Granite Investment Advisors. I want to bring in Tom White, who's been looking at the options for Disney. Thank you. Tom, let's talk here, all right? Let's do the bull case on Disney. I know you got a couple ways to do this. Let's start with the bullish side.
Yeah, so I looked at, they've got earnings coming up first week of May, so I wanted to do something a little bit more longer term on this name, because those parks they're talking Disneyland might not even open before the end of the year, and taking temperatures, I don't know. It's still a big revenue driver, but I wanted to stay risk defined and taking a bullish stance on this name. To Tim's point here, we'll probably see a bigger pickup in the streaming services as the shelter in place continues. But I looked out in the June cycle, and I wanted to do something a little bit different. It's a call condor, and that's where I'm buying a call vertical. That's basically at the money. You buy the 105 strike that's currently about $1 in the money, and you sell the 115 strike against that, creating a long call vertical. But then against it, I want to take advantage of this still high implied volatility, and I want to sell a call vertical that's farther out of the money to the upside, Oliver. And that'd be the 125, 135 call vertical. So as a net package where you're buying a vertical and selling a vertical, where your short strikes are in between the longs to keep it risk defined, you pay roughly about a $3.20 debit on this. Each wing of this condor is about $10 wide, so you're risking $3.20 to basically make a pretty good return on that. You subtract the $10 from that, and you get about $6.80 on this particular spread. So that's your risk reward on it. Break evens are about 108.20 on the upside, so you need it above there. And then all the way up at 131.80 on the upside. So you've got this nice swath or range above 108.20 for this trade to become profitable. You've got about 71 days in it, but it's a bullish trade. But what you're doing is limiting your risk. What if these parks don't open throughout the rest of the year? Maybe subscriber growth starts to level off here a little bit. But we had a couple analysts come out hiking their price targets to about 140, 150 today. So this is a way to take advantage of that grind higher in Disney over the next 2 months, basically. So really nice wide range for this thing to become profitable for you.
All right, so 108 to 131, you don't exactly have to have, this huge ramp in the short term. You're only a couple bucks away from the bottom end of that range right now. It still is generally bullish, though. So, Tom, is that the bullish trade, or is that the cautionary trade that you got on Disney?
No, that's the bullish trade here. Now, you got the stock up, 5-6% today. There's another way to play this to the bullish side, but also giving yourself a little bit of cushion or room to the downside for Disney to trade in. And the next trade I looked at was selling a put vertical but only going out to the May cycle. So you've only got about 37, 36 days in this position. And what you're doing is selling a put that's out of the money to the downside, the 100 strike put. You got about a 60% probability that that strike's going to be out of the money at options expiration, which is what you want. But instead of just selling the put, I want to cap my downside on this in case it does go lower. And then you buy the 95 put. So it's a pretty aggressive short put vertical to the downside. You get that break even by collecting about $1.30. You get that break even about 98.70 to the downside. So your risk reward's a little bit worse on this one, Oliver. But what you're giving yourself is about $7, $8, $9 to the downside before you reach that break even. So it's still bullish in nature, but it's also neutral. So the stock can just kind of settle in here above $100, and you're still going to be fine on this type of trade, but a little bit shorter term. And you can keep doing these short put verticals month after month if you think it's going to stay above a specific price target that you set for yourself. But you're giving yourself better probabilities of success in case the stock market or this stock does pull back a little bit.